Hey everyone, welcome back to Corporate Decoder. Today we're diving into Arculus System Calcio, Limited's latest report, and let's just say their financials are as bare bones as a skeleton at a nudist colony. Get ready for a real look at a company finding its feet or maybe just shuffling them. Before we jump in, if you like your financial news served straight up with no chaser, make sure you hit that subscribe button. And hey, we've also got a thriving community on Discord where we break down these filings even further. Link is in the description below. Alright, so Arculus System Calcio Limited is here with their quarterly report for the period ending December 31, 2024. This is a company that's still in its early stages, and as you'll see, they're not exactly swimming in cash. They're aiming to make it big in the electronic design automation or EDA industry, which basically means they want to create software tools that help design computer chips. Think of it as the architect's blueprint for the tiny brains inside our gadgets. Let's start with a quick peek at their balance sheet. At the end of December 2024, Arculus had total assets of just about $18,000. To put that in perspective, that's less than the price of a decent used car. On the flip side, their total liabilities were a much bigger number, around $140,000. This means they owe more than they own, which isn't a great sign for a company trying to grow. But the difference between what they own and what they owe, which is called stockholders' equity, was a negative $121,000. That's their accumulated deficit, a fancy way of saying they've lost more money than they've made since they started. Now let's look at how they actually performed in terms of making money, or in their case, not making money. For the 3 months ending December 31, 2024, Arculus had zero revenue. That's right, no sales. Cost of goods sold was also zero, which makes sense if you're not selling anything. But here's where the money actually went. Operating expenses. They spent about $30,000 on things like administrative costs and professional fees, which include legal and accounting services. Compared to the same period a year earlier when they spent about $8,000, that's a big jump. So the bottom line for the quarter was a net loss of about $30,000. That means for every dollar they spent, they didn't earn any back. And this isn't new. They also had a net loss of almost $9,000 in the same quarter the year before. When we look at their cash flow, the story is similar. In the quarter ending December 2024, they used about $35,000 in operating activities. This is mainly because of that net loss we just talked about. The only place they saw some inflow of cash was from financing activities, which brought in $50,000. This came from related parties, meaning people connected to the company, likely founders or early investors, giving them money. This is how they're keeping the lights on. This compares to about $12,000 from related parties in the same period the year before, showing they're relying more on this kind of funding. Now, this next part is crucial. In their report, they explicitly mention the going concern issue. This is a standard term in accounting that means there's a real question about whether the company can stay in business for at least the next year. They admit they haven't made enough money yet to cover their costs and that they have accumulated losses. To keep going, they need about $500,000 more. Their plan is to get this from management and shareholders and hopefully from outside investors. But they can't guarantee they'll get it. This is a big red flag that they are very dependent on external funding. Under their accounting policies, they're upfront about this. They're preparing financial statements without an audit, meaning this is management's best guess for now, and they do confess a material weakness in their internal controls. What's the big issue? They say they didn't have enough people with the right accounting experience, and there wasn't a good enough separation of duties. This means there's a higher chance of mistakes or even fraud slipping by unnoticed in their financial records. They plan to fix this by hiring more people or consultants. Looking at their balance sheet again, under assets, we see cash and cash equivalents. At the end of December 2024, it was about $18,000. This is up from just about $3,000 at the end of September 2024, which is good, but it's still a very small amount for a business. On the liability side, accounts payable, which is money owed to suppliers, went down from about $5,000 to $1,000. That's a positive sign. Accrued payroll also went down. However, amounts due to related parties, those loans from insiders, shot up from $87,000 to over $13,700 to over $13,700 to over $13,700 to over $13,700 so over $13,700 to over $13,700. So while some immediate bills are down, their reliance on internal funding is way up. Let's talk about their stock. They have common stock with a par value of very little $0.001, and they have authorized 75 million shares. Out of those, about 4 million shares were issued and outstanding. This is a pretty standard structure for a company. Looking back at the statements of changes in stockholders' equity, we see the net loss for the period ending December 2024 was about $30,000, which brings their total accumulated deficit to over $21,000 negative. This is a growing hole they need to fill. They also mentioned some events that happened after December 31, 2024. They received more advances from shareholders, totaling around $11,000 in February, March, and May of 2025. This just reinforces that cash crunch and their reliance on those close to the company to keep things afloat. Moving on to the management's discussion, they reiterate their business plan, developing software tools for chip design. They highlight their main products, the architecture compiler and iProvider, which they say will help customers design chips faster and better. They acknowledge they haven't started generating revenue yet and that they'll need more money. Their plan is to fund operations by selling more stock or getting debt. They think they have enough to last about 6 months, but after that, they need significant new capital. They also warn that new stock sales will dilute the ownership of existing shareholders. Here they admit their disclosure controls and procedures were not effective. This ties back to that material weakness we saw earlier, not enough experienced staff and poor segregation of duties. This is a common problem for very small early stage companies, but it's still something investors should be very aware of. And finally, towards the end, we see the standard exhibits and certifications required by the SEC here. So what's the story here? Arculus System Company Limited is a company with big ambitions in the complex world of chip design software. They have a vision for their products, but right now they're like a business toddler. They're not generating revenue, they're burning cash, albeit a small amount, and they're heavily reliant on funding from their own people to survive. The biggest strengths are the clear vision and the potential for growth in a high-tech field. If their EDA tools are as good as they say, they could become a valuable player. However, the weaknesses are glaring. No revenue, a growing deficit, and that material weakness in their internal controls. They absolutely need to secure substantial funding to execute their plan and prove they can actually make money. Their future hinges entirely on their ability to attract outside investment and start generating sales, which are two very big ifs right now. For investors, this is a very high-risk, early-stage play. It's more akin to betting on an idea and a team than investing in a stable business. You're looking at a company that is very much in the build it and hope they come phase. Alright, that's our breakdown of Arculus System Cody's latest filing. What's your take on these numbers and what they signal for the company's future? Do you think they can pull off their chip design dreams, or are they destined to remain a microcap curiosity? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out. And remember to subscribe for more deep dives into the world of corporate finance, and definitely check out the Discord link in the description to join the conversation. Thanks for watching, and we'll see you on the next Decode.